Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by CommercialAgentSuccess.com. It is the ultimate and commercial broker training. Learn more at CommercialAgentSuccess.com. Well, as we've started 2023 here, one of the big things that's on the commercial real estate participants' minds are the availability of financing. What's happening with existing loans as these loans mature and rates are much higher. How much default do we have going on now in the lending market? What should we expect moving forward? Well, please welcome my guest. It's Lonnie Hendry. He's Senior VP and Head of Commercial Real Estate Advisory with Trepp. Lonnie, good to see you, and thanks for joining us, sir.
Thank you, Michael. I appreciate the invitation to come on the show. Big fan of the show and looking forward to delving into the discussion today.
Well, great. Well, thank you, Lonnie. And, first of all, if we could start with the amount of maturities happening in 2023, and, because it seems like a lot of those loans may be at much lower rates than borrowers can get today, right? What do you see on the horizon?
Yeah, it's an interesting question in the sense that it's top of mind for everyone in the marketplace. So we thought maybe we were going to see some distress coming into COVID. There was a lot of, equity raised for placement into distressed assets, and that never came through based on some government stimulus. But now with the Fed taking its aggressive posture, maturities in 2023, I think, have been the headline or top of mind for everybody in the marketplace. So, Trepp is a data and analytics modeling company. We focus primarily on the securitized debt market. So I have some stats here that we'll provide for the listeners covering those securitized markets. So Fannie, Freddie, Ginnie, FHA, CMBS, CRE, CLO. And as it pertains to 2023 maturities, we're showing about $119 billion worth of upcoming maturities in 2023, which is a fairly large number, led by multifamily. There's about $33 billion worth of multifamily loans coming due in 23. Office comes in second at about $22.5 billion. Industrial is just over $21 billion. Retail is about $13 billion. And then lodging rounds it out above $10 billion at about $12.5. Interesting nugget on those, though, is of the $118 billion in total, about $80 billion, 500 million of that is floating rate. So you mentioned, we're in a considerably different interest rate environment now than what those loans were in at origination.
Wow. So again, how many are in the floating rate type loans?
So about $80 billion of floating rate loans. And that's led again by multifamily. So multifamily has a total of $32 billion maturing in 23. Of that, $22 billion is floating rate. And so it's going to be really interesting to see how that plays out in the marketplace. We've done some research around interest rate caps and the cost of those. And so we'll see how the market reacts to, these properties coming online, especially in the office sector where you've seen a decline in occupancy. You've seen an increase in cap rates in some markets where there actually is transaction. A lot of markets, there haven't been a lot of transactions. So lenders are really looking at weighted average lease term and some other underwriting metrics. It'll be interesting to see if some of those offices are actually able to even refinance.
Yeah. Well, what are you seeing in default so far, Lonnie?
Yeah, so on the default, so we have a couple of metrics here. So we track delinquency. So delinquency top line would look at, properties that are at least 60 days behind on payment. So in the securitized world, if you miss your first payment, you effectively go into grace period. After you've missed 2 consecutive payments, then you'd be considered delinquent. And in that instance, on the delinquency side, the numbers actually look pretty good on the whole. So overall delinquency as of December of 22 was sitting just over 3%, so 3.04% on the universe of properties that we track. If you compare that to 12 months prior, so December of 21, we were actually sitting at 4.57%. So even given the interest rate environment, the aggressive nature of the Fed, which we all know, they've raised rates at an unprecedented pace in 2022. Delinquency was actually down year over year. Lodging was the biggest mover there. Lodging was about 9% delinquent in December of 21, and that was reduced down at year end of 22 to about 4.5%. If you look at, properties that are actually in foreclosure, REO, or have some form of delinquency, just to put some context around that in terms of loan balance, we're looking at about $17.5 billion worth of loans that are, 30, 60, 90 foreclosure or REO status.
Already, right now.
Right now, and that's led by the retail sector, so no surprise there. Regional, super regional malls have definitely had the headlines, and they still do. There's about 6.7 billion worth of retail properties, which are primarily regional and super regional malls. We have had some green shoots in that space over the last couple of months. We've seen a couple of malls, be granted extension options or be able to refinance with some equity contributed at closing by the borrower. But just to give some geographical preference or geographical reference, I should say, in terms of the retail delinquency right now, New York has the highest loan balance of delinquencies on the retail sector. It's about 3.6 billion. Texas is second with about 1.8 billion. Then you have Illinois, New Jersey, California, and Florida that round out the top six there. So Florida comes in just about 750 million. And again, New York sets the high water mark at 3.6 billion.
Interesting. And what do you expect moving forward through the rest of the year? As you mentioned, there are a lot of opportunistic buyers out there that look forward to these times of distress, maybe every 10 or 12 years or so. What do you expect this year?
It'll be really interesting. We just wrapped up the CREFC conference in Miami a couple of weeks ago, and I think one of the central themes from that conference, and I've heard it on some other panels that I've been a part of over the last couple of months, is that the market's kind of suspended right now in a game of chicken. You have a pretty large disparity on the bid-ask spectrum from the seller's perspective and buyer's perspective. I think the maturities that are upcoming, not just in 23, so we talked about the 118 billion worth of maturities in 23. If you look at 24, so you go out 2 years, there's $151 billion worth of maturities in 24. And about 80 billion of that is also floating rate. So if you look at the next 24 months, I think with the maturities, it's going to force the hand of some of these property owners to have to face reality of cash in refi if they wanted to try to refinance their loan, or they're going to have to come down on price, and buyers are going to potentially be able to buy some of these assets, at a discount, especially in certain markets. If you look at Chicago, their office and retail markets have been pretty decimated coming out of the pandemic. There's been a lot of stories about San Francisco office. I think I saw something this last week that office, availability there was about 30%. In Minneapolis, we've done some stuff up there. There are about 2 million square feet of sublease availability. So, you have certain markets that are really going to see, a combination of increased interest rates, significant loan maturities, and buyers sitting on the sidelines ready to jump on the opportunity to buy distressed assets.
What would be your advice to borrowers who potentially have maturity coming up this year or next, and maybe they realize right now that the NOI is not going to support a new loan?
Yeah, so I think this is, from the operator's perspective, if you're an owner of a building, obviously you can't, individually remove the storm clouds of the broader macro environment we've described. But what you can do is be proactive. You can reach out to your lender. You can tell them exactly what's going on with your property. You can differentiate how you're going to drive leasing velocity at your buildings, how you're going to increase, retention with your current tenants, how you have a management strategy that's going to allow you to persevere through this interest rate environment. And I think lenders on the whole, they don't want to take these properties back. And so if you have sound management, if you have a strategy, if you can articulate that, if you have some data to back up your thesis, I think you have some favorable outcomes. And maybe, the favorable outcome for most, office owners, as an example, over the next couple of years would be maybe you don't get that full refi that you want, but maybe you can contribute some capital and get a 24-month extension. And hopefully in 24 months, interest rates have, settled down or come back down to what, we've seen over the last 5 or so years. And, or, maybe work from home has dissipated a little bit, and more, employers are requiring tenants to have their people in the office daily. And so I think that would be my, suggestion, is be proactive. I definitely don't think this is a head in the sand type of moment. because there's definitely too many storm clouds on the horizon that if you let somebody else control the narrative is not a positive one at the moment.
Hmm. That's right. That's good advice. We come in a lot of times as third-party brokers to kind of be the middleman to help a borrower and lender figure out, hey, is this plan really realistic from a third-party point of view? So great advice. Lonnie, what about investors who may be looking to pick up loans or pick up distressed properties? Any advice for them?
For sure. I think, a couple of things, and I've been making this point on a lot of the different outlets that I've had an opportunity to speak on. I think sometimes those of us that are in the business take for granted that, the layperson or maybe somebody that's new to the industry, they hear some of these headlines or they read the headlines or they hear people talk about them on podcasts about, the market's down X percent or vacancy is, at a certain number across major markets. But there's no such thing as a national real estate market. Real estate, by definition, is a local and sometimes a hyper-local endeavor. And so, for investors right now, you can't sit back and say, well, there's just going to be broad distress across the U.S. and you're going to be able to scoop up assets in any major market at some, percentage discount. The reality is some of these markets are actually going to persevere and they may see very mild distress. And some of it's a function of timing, depending on when the loans were taken out, depending on how cash flow positive some of these assets are and their ability to get extension options and others. But you look at some of these markets where, maybe some of the underlying fundamentals, migration patterns have negatively impacted them, or maybe large scale employers have really downsized in those markets. If I'm an investor, I'm looking for those broader macro signals to tell me which markets I think are going to feel the most pain, but I think still have long-term viability. And then I'm really delving into some of the properties within those markets and trying to find, opportunities that meet my underwriting criteria that I think I can add value to over a hold period that has, long-term viability and maybe just some short-term suffering based on some factors that, maybe have been brought on by COVID. If you look at some of the migration patterns, people moving out of major cities like Chicago and New York and others, I'm bullish on those cities long term. I think people come back there. I think those markets return to vibrancy. New York obviously has at a much faster pace than Chicago. But that would be my advice. Find cities that have long-term viability that maybe have suffered from some of these short-term external obsolescence features, and then really dig in and find some properties that meet your criteria.
Yeah. Well, good advice. And I love the word hyper local, talking about real estate performance. And because sometimes a property, two similar properties across the street from each other have significantly different performance and values, right? And Lonnie, what about new loans being closed in the CMBS, Fannie, Freddie? What have you seen last year? What do you expect this year? Are we going to have available financing to take out these loans that are maturing?
Yeah, I think that's a great question. What we know about real estate is, it's an industry that thrives on certainty. So if you know exactly what interest rates are going to be, then you can underwrite that from a lender's perspective. If you know what a market rental rate is, then as an operator, you know what type of value you can add to a property. When you know what cap rates are based on transactions, then you can fairly and accurately assess the value from an acquisition perspective. Right now, we're in a market that's completely uncertain. We don't know exactly what the Fed's going to do. We haven't really seen a repricing of assets at this point, so nobody's really certain of what the value is. And all of those things have downstream implications in terms of liquidity in the market. So I think lenders are optimistic. They want to make loans. They have capital available to make loans. The challenge for them is that they have to underwrite to current interest rates, to current risk metrics. And some of those are still not really quantifiable and a little bit unknown. So I think issuance we've seen since July of 22 has really nosedived. And I think for this first quarter of 23, we're expecting muted, issuance on the whole. So just to give some statistics here or some context, in 2021 on the CMBS, so this would be your private label CMBS deals, we had 164 total deals in 2021, which accounted for about $118 billion in issuance. If you look at 22, there were only 96 deals, and about 72 billion in issuance. So roughly, 60+% of what it was in 21. And I think you could see something very similar in 23, as those markets are still fairly frozen at this point. The agency markets have, this was the first time, I believe, since the FHFA has taken over the GSEs that they didn't hit their lending caps in 22, and they've actually revised their lending caps in 23 downward. So I think that kind of gives you some sense of, where market expectations are for issuance there. And then the last market we track is the commercial real estate collateralized loan obligation. These are short-term bridge debt financing. And in 21, there was about 45 billion in issuance. We saw a pretty dramatic decline in 22 to just over 30 billion. So it'll be interesting to see how, borrowers, especially in that space, those are traditionally transitional loans, value add, reposition type of opportunities, driven primarily by multifamily. It'll be interesting to see if there's still an appetite for that heading into 23.
Yeah, it sure will. And I think as far as lenders go, these might be some of the safest loans they would do today than they've done in a long time, because at least we do have higher interest rates now, right? If they close a loan now, they don't have to worry about that situation, and maybe less competition with other lenders. So I know there's a lot of lenders that are real active, even in the office sector right now. Well, Lonnie, what would you leave our audience with to think about regarding this market we're heading into?
Yeah, I think we can all get caught up in the headlines. I think a couple of takeaways would be, if you and I were recording this discussion 5 years ago, the headline was the retail apocalypse and the death of retail. And that's what all the short shows and all the practitioners, we were all talking about what's going to happen to retail. And I think if you look at where retail is now coming out of the pandemic, bad retail's gone away. The retailers that were able to adjust to COVID, create an omni-channel type of delivery mechanism, they've survived, and retail is actually one of the best performing sectors on the whole right now. If you look at the headlines today, it's office, it's doom and gloom. No one's coming back to work. These offices are obsolete. There's no real, logical adaptive reuse that doesn't require zoning and, exorbitant expense, et cetera, for residential conversions. My takeaway is that the real estate market's resilient. Commercial real estate's a huge part of our economic engine. We are all taught, when you're in undergrad or grad school and you're learning about real estate, it's a cyclical business. And generally, the cycles have been somewhere between, 7 to 9 years. We're probably, 10 plus years into this cycle without any type of a firm repricing or resetting a basis. And I think we're probably going to see that over the next couple of years based on some of the data we talked about today. But I think that's healthy for the market in the long run. We need to see some of these assets that are older repriced to something that makes more sense. And once we do that and people have a reset basis, they'll be able to add value. They'll be able to renovate. They'll be able to keep those assets viable longer. So, I would say it's not all doom and gloom. This is part of the process. If you're capitalized and you can survive, you'll come out on the other end in a better spot. And if you're not, unfortunately, some people are going to lose their buildings. But hopefully some investors come in and finish renovating, remodeling, doing whatever they can to make those buildings viable for the longer term.
So it's not doom and gloom. Everything's going to be okay, is what you're telling us.
Yeah, I think we're going to feel some short-term pain, but yeah. I think, you have to take the longer-term objective. I mean, one of the, and this from your business, investors look at real estate, and one of the inherent benefits of real estate is that it's fairly illiquid. That does create value for them as an asset class. It's a challenge in times like this, but the reality is if you can persevere, we've survived in interest rate environments of 6% plus. I think what we're seeing is this unknown commodity of what our interest rate's going to settle in at. If everyone knew interest rates were going to stay where they are today, I think that repricing happens much more quickly, and I think things start to operate more efficiently. It's this unknown where people are hoping that rates come down, so they're willing to hold on a little bit longer, when the reality is if they stay, they would probably sell out, and the cycle would just take care of itself.
That's a good point. We were pricing a hotel sale for a client this morning, and he was asking us, all right, if I sell it now, all right, you got this kind of cap rate range in mind. What if I'm doing this a year from now? And so, we pulled up the systems and reports and everything. So, well, we think depending on the interest rates, we could be 25, 50 basis points higher on a cap rate is our estimate, in a year from now. So, it would be good to see where it shakes out. Final thought, Lonnie?
I really appreciate the opportunity. I think the marketplace is dynamic. It's an interesting time to be a practitioner in the space. But again, it's a resilient market, and I'm optimistic on the long term that, if we sit down and we talk again here in 18 or 24 months, I think we'll be talking about the upside in a lot of these markets that are struggling today.
And we'll do just that. Lonnie, thank you for joining us, sir.
Yes, sir. Thank you so much.
And thank you for joining us around the country. Please let us know what you think. If you'd like to know more from Lonnie Hendry with Trepp, their website is Trepp, TREPP.com. Well, thank you for joining us. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, creshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.